good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday, September 28th, and wow, it's the quarter's already ending up, and it's going pretty quick here. So we'll be heading into the fourth quarter here shortly with October next week. We got quite a few economic news releases scheduled for today, so we'll jump right into it for you. We'll start off with the personal income for August. So back in July, it was actually at a 0.3, but they revised it lower. So personal income didn't rise as much as they thought back in July. So it was revised from 0.3 to 0.1. And they figured it would be about 0.2 personal increase for August. And it just stayed at 1.1% increase. So personal income is going up very, very slowly. And then we got the consumer spending. On the other hand, people, you get money coming in, and now we'll see how people are taking money out. So they had back in July about 0.4% people spending increase of spending. Then we had a 0.5%. It was the forecast, and it came in forecast. So right now forecasts are looking pretty good. They're getting that forecast pretty accurately on this morning's releases here. So basically what they're saying that people are starting to spend more than what they have. They're dipping into their savings to buy things. And this isn't necessarily good. What they're finding is that a lot of this is due to gasoline prices, which leads little for other things like retail, clothing, electronics, those type of things, which could lead to more jobs where if you look at gasoline, in some ways it could be real, if you think about it, inflationary. So our costs are actually going up. The next item is the core PCE. So let's talk about inflation. Here's the Fed's favorite gauge for inflation for the month of August. And we had a 0% so no growth in July. And we figured it would go up about 0.1%, and it came in at forecast. So year over year, right now we're at about 1.6, so we're below the Fed's target goal of remaining below 2%. So that is a good sign that we're still inflation hasn't gone out of control, or it looks like it's getting too much out of whack. So, but I would, without government spending, I would advise watching that very carefully. Chicago PMI. This is the manufacturing in the Chicago region. We had a 50.3, so it's almost like very stagnant. So what that means is that anytime you're at 50, which is very much at par level, meaning that there's no growth. So anything above that is expansion. Anything below that is contraction. So. And we figured, and basically it contracted. So not good news for September Chicago PMI. So manufacturing in the Midwest came in, unfortunately, a bit poor. And then finally, we got the consumer sentiment for a month. This is the final revision. We had one earlier in the month. Earlier in the month, they thought it was 79.2. Previous month, it was about 74. So it was a pretty big jump from the month of August to September. We figured the forecast would go up slightly higher, but actually dipped down a little bit. So the final forecast went from 74 to about 78.3. So still a good jump there. So obviously that means people are kind of feeling good about finances and where they're at with things and stuff. So this is where people are kind of, where their moods are. Now we'll jump over to the headline news. So the stock market's down. So part of it is the technicals from the PMI, the Chicago PMI. A lot of it has to do with that. And then another thing that has investors worried is right here. They're kind of waiting for the review of Spanish debt. So they're doing some stress tests in Spain. There's concerns that maybe their bonds might get thrown into junk status. So they're kind of waiting word. They're supposed to be reviewing it both, and by end of the markets today in the European markets, that they'll probably be releasing their report. So right now they're on edge as to what's going to happen here. So let's go ahead and take a look at the bond market, see what interest rates are doing today. So after we did this, it dropped a bit, as you could see yesterday, and today we started the day up, but now we're kind of moving downwards again as well. So we're right now kind of hovering in the 105.50 mark. A lot of this has to do with it's more, we're at the high end right now, and investors are just kind of cashing in on the profits right now because it's kind of in a more or less an overbought position. As you can tell by how far it is off from the 10-day moving average, how far it got up, and 10-day moving average up. So we're getting a little bit closer towards the 10-day moving average. So right now, interest rates are pretty much about in line where we left off yesterday. There's not a huge difference. As you can see, we left off at 105.47 yesterday. Right now we're at 105.50. So right now the pricing's about the same where we left off yesterday. Now if you want to start in the day yesterday where we started, again, it would be pretty similar. So right now we're kind of looking similar to what we had earlier in the morning. We're probably a little bit better, and it worsened as the morning went along with the bond price going down. So remember, when the bond prices come down, interest rates go up. When bond prices go upwards, as you can see the higher level up here, that means interest rates improve. Alright folks, thanks for stopping by. Hope you guys have a wonderful upcoming weekend here. I will see you guys on Monday. And if you guys like to see these reports on a daily basis, just stop by mikesdailymarketreport.com. There's a little feed burner you can subscribe to, and I'll email you these free reports to you on a daily basis when I upload them. Have a great day.